Recently, an article from the Washington Times claims that Joe Biden's new mortgage plan that's going to be going into effect on May 1st is going to be hiking the payments for good credit homebuyers in order to subsidize the risk for high-risk homebuyers. But is that what's really going on here? If you've been following my channel, you'll know that I posted a video a few months ago talking about the recent changes to FHA loan. And with these changes rolled out by the Biden administration, it has made it a lot cheaper for those who are putting a lower down payment to consider an FHA loan instead of a conventional loan because they lowered the price of the mortgage insurance premiums for FHA borrowers. But what this article specifically is claiming is that homebuyers with a bigger down payment and a higher credit score are actually going to be paying more than people with lower credit scores and lower down payments. And not only that, the differences in those payments are going to be going to subsidize those higher risk mortgages. So if you're thinking about buying a home in 2023, you're probably wondering how this impacts you, especially if you've been doing a good job preparing by getting a higher credit score and saving for a bigger down payment. So in this video, you're actually going to learn what's really happening here. We're going to talk about what this article claims is happening. We'll get a refresher on what's changed with FHA loans and why they've become a little bit better of an option. And we'll talk about some of the big changes that are coming for conventional loans later on this year that may make it a little bit more expensive for you to buy a home. Now, if you're new to the channel, my name's Katon. I'm one of the top loan officers in California. And on this channel, I help people just like you learn how to buy their first home and make the mortgage process a lot easier. And speaking of making mortgages a lot easier, let's go into these changes and actually show you why it's actually going to be a little bit cheaper for you to buy a home, even with these new changes. All right, for starters, let's talk about the article from the Washington Times. So the Washington Times opens with their headline, Biden to hike payments for good credit home buyers to subsidize high-risk mortgages. It's very interesting that they say Biden at the front of it because there's no mention of him for the rest of the article other than the headline. The article then continues talking about some of the new changes that are coming from the FHFA. And these changes are true. Starting on May 1st, Fannie and Freddie Mac are going to be rolling out some changes to what are called LLPAs, or loan level pricing adjustments. Basically, what these are additional fees that are rolled into your interest rate depending on your loan to value, your credit score, as well as things like DTI. And we'll talk about those changes specifically in a minute, but the article goes on to say that the average home buyer with a credit score of 680 or higher can expect to pay $40 a month extra for a $400,000 home. It also goes on to say that home buyers that are making a down payment of 15 to 20% are going to be socked with the highest fees. Now, while there's some truth to this, there are going to be some changes coming to how Fannie Mae and Freddie Mac are going to be rolling out their loan level pricing adjustments. You'll notice that this is Fannie Mae and Freddie Mac doing this. There's been zero executive action from the Biden administration or even from the Fed directing the GSEs to do this. Now, as far as why they're making these changes, to be honest, I don't know. For me, it feels like a money grab. It feels like a really weird change at a really bad time. Basically, interest rates are high right now and prices of homes haven't really gone down all that much. So now on top of high interest rates and high home prices, now Fannie Mae and Freddie Mac are to come in and start charging people more on top of that. It makes no sense. And honestly, as a mortgage professional, I really don't agree with these changes. And I've contacted my representation to really see if they can do anything to unwind these changes. But here's the thing. The article doesn't mention anywhere else other than the headline and the initial statement that this is going to be subsidizing high-risk homebuyers. Now, Fannie Mae is definitely making some changes with their pricing adjustments to make it a little bit cheaper for people who are already paying high fees as is to get into a conventional loan, which I think is a welcome change. I think somebody with 20% down should still have the ability to use a conventional loan even if they've got a 680 or lower credit score. But to claim that this is somehow subsidizing their ability to buy a home by using somebody else's credit is completely untrue. More importantly, like I mentioned, this has nothing to do with what's happening with the FHA loans. As a refresher, the FHA reduced mortgage insurance premiums across the board that are paid monthly. And in doing so, it's made it a lot more affordable for people who are looking at their conventional options versus FHA, especially for those who have less than perfect credit. Because FHA loans are federally insured, they have lower interest rates than their conventional counterparts. The big knock was always that they had higher mortgage insurance premiums across the board. But now, if you've got a higher credit score but a lower down payment, it might actually make more sense for you to go the FHA route versus conventional because of the lower rate and the lower mortgage insurance. And honestly, I think that's a positive change, not a negative one. If anything, I would hope this actually spurs a little bit of competition in the market from the mortgage insurance providers to make mortgage insurance premiums cheaper for those with even higher credit scores to incentivize them to stay on the conventional route. For example, somebody buying a $500,000 home, putting 5% down, if you're looking at conventional versus FHA, not only will your mortgage insurance premium be cheaper by about $12, But on top of that, because you've got a lower rate, about a 0.5% lower than your conventional option, you're going to be saving around $105 a month. So going back to that article, to say that somebody with a higher credit score is going to be suddenly paying more than someone with a lower credit score is just not true. The big difference here is now you have a different option. Now, moreover, the changes to the FHA mortgage insurance premiums were something that obviously were done by the Biden administration this year. The changes to mortgage insurance premiums and getting them slashed goes back all the way to 2016 to one of the last actions that the Obama administration actually had tried to sign into law. And they had actually successfully made that change until the Trump administration came in a couple of months later and basically unwound those changes. And the idea of slashing the mortgage insurance premiums for FHA buyers had nothing to do with it being subsidized by higher credit buyers that are using conventional loans, but simply because of the fact that because of record low foreclosure rates, the amount of money that the government had collected from these mortgage insurance premiums were at all-time highs. There was simply no need for them to have this much in reserves for mortgage insurance premiums. So they simply said, hey, we're just going to cut these mortgage insurance premiums because obviously, number one, what we've done with Dodd-Frank is working to make sure that people aren't foreclosing on their homes. But two, we have basically 5 to 10 times more in reserves than what we actually need if foreclosures started happening. So we can afford to cut these premiums a little bit and give people a break on their homes. Now, let's talk specifically about the changes that are coming for Fannie Mae and Freddie Mac and those loan level pricing adjustments. For starters, the effective penalty for having a credit score lower than 680 going conventional is a lot smaller than it was. Now, granted, it still costs more to have a lower credit score. You're not going to get a lower rate than somebody who has a 740 or higher. So, for example, if you had a 650 credit score, you'd be paying a fee equivalent to 1.5% of the balance of your loan, whereas you'd pay no fee at all if you had a credit score of 780 or higher. But before these changes, the person with a 650 credit score would have had to pay a whopping 2.75% in fees. So on a hypothetical $300,000 loan, the person with that lower credit score is saving themselves about $3,700 in closing costs. But the person with the 780 is not affected by these changes at all. Now, while that's great news for those with lower credit scores, here's where it gets a little bit more interesting. So take a look at this graph and feel free to pause at any time if you want. This is kind of a color spectrum of the different changes that are coming for LLPAs based on your down payment and your credit score. And you'll see, of course, the ones represented in green are where it got a little bit better, and the ones where it's in red got a little bit worse. So you'll see on this chart here, some of the biggest changes are coming for those who've got a credit score between 720 to 760 and are putting about 15 to 20% down. So generally speaking, borrowers with higher credit scores can expect to pay a little bit more than what they're paying right now, but this doesn't necessarily come out of upfront costs. Typically what will just happen here is that lenders will charge a higher interest rate. So, I mean, yes, technically the costs are still there, right? You're paying it longer over time with a higher interest rate versus paying it up front. It's up to you what you want to do. But what is interesting to see is on that top line, for those who've got 780 credit or higher, there's virtually no change at all. Moreover, I think they're actually doing some home buyers a favor here. Obviously, as we know, the cost of homes are high right now. So a lot more people are putting less down than they usually would. So generally speaking, if you're putting less than 5% down across the board, across all different FICO scores, you're actually getting a little bit better of a rate. So technically speaking, they're giving you a bigger break if you're putting less money down. And if you're putting more money down, they're actually jacking up your interest rate or your costs by a little bit. But let's go back to the original point that this article was somehow trying to make. Their whole argument was that if they're putting 20% down or 15% down, you're somehow going to be paying more than somebody who's got lower credit than you and putting a lower down payment, which in doing the math, it's very obviously that that's just not true. For starters, let's just look at a straight up conventional purchase apples to apples. We'll do somebody that's putting 15% down and it's got a 780 credit score versus somebody who's got a 680 credit score and who's putting 5% down. It's very clear to see here that even with the lower percentage down, because of that lower credit score, they're paying a higher interest rate. Obviously not as high as it would have been before, but that's a good thing. But when you look at the totality of that mortgage payment, you'll see that the person who's got a lower credit score and a lower down payment is obviously paying more, to the tune of almost $460 a month more. And even if you wanted to compare conventional to FHA, you'd find the same thing. Even though the FHA's got the lower rate, because of the bigger down payment that the conventional buyer has, the FHA buyer is paying almost $220 a month more. So if you're watching this and you're trying to figure out how this impacts you as a home buyer this year, here's what I have to say. If you're putting less than 10% down, I would say take a look at your options between conventional and FHA. There's a high likelihood that conventional might actually still be the better option, especially if you've got a high enough credit score where you can completely remove the mortgage insurance even at 10% down. But for the vast majority of people, even with good or bad credit, FHA is probably going to be the better option for you. You're going to pay less in interest, you're more than likely going to pay less in mortgage insurance, therefore having a lower monthly payment. Now, if you're putting a higher down payment, we're talking 15, 20, or even 30% down, there is zero reason for you to be weighing the options between conventional and FHA. The only reason you should be even remotely considering FHA is if you have a lot of debt or if you've got a lower credit score. But if you're somebody who's got a FICO score of 700 or more and you're putting 20% down, the obvious answer is to go conventional, simply because you're not going to have the mortgage insurance. You see, with FHA, regardless of how much you're putting down, you're still going to have mortgage insurance. And the soonest that mortgage insurance is going to fall off is 11 years from now. So while yes, as a conventional buyer, your interest rate might be higher than the FHA's counterpart, this has always been the case. And moreover, your payment is going to be less because you don't have mortgage insurance, where the person who has an FHA loan will. So whether we like it or not, these changes are coming and they are going to impact home buyers. However, this is not going to magically make it significantly worse for somebody who has a bigger down payment and has perfect credit to buy a home. Someone with a lower credit score and a lower down payment is not going to magically have a better payment than you. It simply just doesn't work that way. But what these changes combined really do is make it a little bit more interesting and gives first-time homebuyers a little bit more of an option. It makes it a little bit easier for those with lower FICO scores and less down to consider a conventional option, whereas those with good credit and less down now have an FHA option that might be a little bit cheaper for them monthly. Life in home buying is all about choices, and the fact that now most homebuyers have more choices than ever, I think is actually a positive win. Now, like I mentioned, I don't really agree with the rest of the LLPA adjustments. A lot of them don't make sense to me. There isn't much we can do about them. These changes are coming and we have to adjust. So if you're thinking about buying a home in 2023 and want to figure out what option is going to be best for you, conventional or FHA, especially if you're putting less money down, make sure you click the link in the description below to book a one-on-one call with me and my team. We'll help walk you through your options and figure out what mortgage is going to make the most sense for you and what's actually going to save you the most money. It's completely free. There's no obligation to work with us at all, but I want to help as many of you out there to buy your first home this year. Speaking of buying a home, the number one place that you should start is not on this video, but actually with getting pre-approved for a mortgage. And if you want to get my best tips and tricks for getting pre-approved for a mortgage this year, that'll help really speed up the process, make sure you watch this video next that covers all my best tips and tricks. Now, if you like this kind of content, make sure you leave a like button. It really helps with the algorithm and helps share this with other people. And if you want to stay up to date with all of the different mortgage news and updates, make sure you hit that subscribe button as well. But that's all I've got for this video. I'll see you in this video next. Take care, and I'll see you in the next one. Bye.